Fannie Mae is instituting a new scoring model that looks more in depth into a borrower's background, and the hope there is that it will help more people be able to qualify. But again, we're going to have to wait and see if this actually works out, Joe.
You know, I wonder too, Diana, if you're looking at two different FICO scores, the idea behind it being if you don't qualify on one, maybe you qualify on the other. But is there the chance that even if you do qualify on one, the other one disqualifies you, so it makes it harder for borrowers?
When you look at that, this new idea of looking further into someone's credit history that Fannie Mae is now doing, they call it trended model. That's supposedly going to help a little bit for those who maybe were self-employed or something like that. But again, they are looking for that score, and they're such sticklers on this. I know I've seen refis fall apart over 5 points.
Credit reporting agencies are changing their rating system. And as CBS 2's Emily Smith reports, they're about to start looking a lot deeper into your personal finances.
To qualify for a mortgage to buy a home, it's always been about your credit score and whether or not you pay the minimum on your credit card bills and loans each month. But now millions of potential homebuyers' habits will be under a microscope, zeroing in on exactly how much you pay and more.
The problem with this is consumers don't know about it.
On-time payments won't be good enough anymore. It's a new credit scoring system called Trended Credit Data, and it goes into effect June 25th. The first to do it will be Fannie Mae, one of the largest mortgage lenders in the nation. Financial expert Paul Oster says it's incredible how in-depth this tracking system will go into your history.
They're also going to start using utility data. All utilities, your water, your electric, your sewer, is all going to be included on your credit report.
Oster says even your cell phone bill and a late payment to a company that doesn't even penalize you for it could now affect your interest rate. And our experts say if you think it's illegal for your utility company to share your payment information, think again. Oster showed us his own utility bill and says he has looked at many other similar large companies. All of them tell you in fine print your payment information is being shared.
And we will not disclose a customer's information without prior consent, except as required by law, requested by regulatory agencies and governmental authorities, or to be used for legitimate business purposes.
And it will go back 2 years or more. Licensed loan officer Bill Hendrick says a number of people looking to buy a home this summer won't qualify for a mortgage, or they'll end up with a higher interest rate. We reached out to Fannie Mae about the changes, and a spokesperson said, quote, it simply makes sure responsible, solid lending is going on, and we have a better understanding of the potential risks. In Eatontown, New Jersey, Emily Smith, CBS 2.
Data, historical data, time series data. A lot of customers have been asking about it. And at Equifax, our answer is Equifax Dimensions. Equifax Dimensions is a suite of consumer credit attributes and raw data built off of 24 months of credit history. The attributes are calculated from time series, trade-level data that captures credit behavior such as spend, payment, and usage for the previous 24 months. Dimensions has 500 attributes calculated off 10 fields, more attributes than our competitors. A consumer's past behavior can help predict their future behavior. We analyze those past behaviors to develop attributes that can help predict future outcomes. Our latest solution of quantitative attributes provide unique insights into the true behavioral trends of that consumer. This allows customers to target certain consumer behavior patterns, such as spending, utilization, or payment predictability, enabling them to make stronger decisions while managing policies or marketing to consumers.
When you only see part of the picture, you don't get the whole story. What would you do differently if you had a more complete picture of risk? Millions of Americans have limited access to credit because they can't be scored using traditional methods. That means fewer customers for your business. What if you could open the door to financial freedom for millions of people? More data means more opportunities for customers and new insights for lenders to score more accurately. So how do you fill in the missing pieces so you can say yes more often? The powerful combination of trended data and alternative data sources, incremental to credit bureau trade line data, paint a more complete picture. Trended data expands on the limited snapshot of one point-in-time conventional scoring methods using more variables that are better at predicting risk. With trended data, You can gain a deeper and broader view of a potential borrower's payment behavior with historical account data and actual amount paid over minimum due. Alternative data sources provide a more holistic perspective on your marketable universe, wherever they fall on the credit spectrum. These additional data sources reveal available assets, capacity to pay, and alternative lending activity to help better identify more creditworthy borrowers. Alternative data sources effectively score more than 90% of applicants returned as no-hit or thin file by traditional models. Together, trended and alternative data assets deliver a more comprehensive view of risk, so you can confidently say yes more, offer optimum pricing across all credit risk tiers, and potentially gain customers for life. Now score up to 95% of the U.S. adult population. Get the complete picture.
The definition of the Trended Credit Data Report was just released by Fannie Mae, and it's an enhanced new credit report with new valuable information with up to 30 months of pay history for each trade line. The purpose of the new Trended Credit Data Report is that it gives you a more in-depth dive into a borrower's pay history. In the past, a regular credit report would just give you a snapshot of that borrower's credit report at that moment. If in the middle of the month a borrower had charged $500 on a credit card when they had a $1,000 balance, then you would just see that they had 50% of their credit utilized. With the new Trended Credit Data Reports, you're going to be able to see if a borrower, on a monthly basis charges $500 or $1,000, and if they make the minimum payment each month, or if they actually pay the account off each month. I think the way that it affects a borrower from a personal standpoint is you're going to see your credit report jump from, on average, 14 to 20 pages to somewhere between 30 and 40 plus pages. Each trade line is going to have up to 24 to 30 months of pay history broken down, so that's a lot of additional information that's going to be included in new credit reports going forward. From a mortgage standpoint, what we're going to have is the ability to analyze much more information. Exactly how the information is going to be utilized with that pay history hasn't really been released from Fannie Mae as of yet, but if nothing else, we at least know we'll be able to look at the trends and tendencies of a borrower's pay history for the last 24 to 30 months, if they made that minimum payment, or if they paid it off, or if they didn't pay, or whatever going forward. We'll be able to see that and be able to make a better prediction going forward. Fannie Mae will be releasing their new automatic underwriting system, AUS, version 10.0, the weekend of June 26th. And with that, any file submitted on or after that weekend will be required to have the trended credit data information included into it.
I'm going to give you 3 ways to beat trended credit data. There's been a lot of talk of trended credit data. Fannie is making more announcements on how they're going to handle it. The repositories, TransUnion and Equifax have introduced the data. Experian has not. Come the end of June, beginning of July, we're all going to remain on the same FICO scoring model we've always been on, but the Fannie Mae underwriting will incorporate the trended credit data, which will create a bunch of unintended consequences But for now, I want to give you 3 ways to beat trended credit data. So when you talk about trended credit data, you have to think about what is it talking about, what is it looking at. What they're looking at is what is your payment and what did you pay, what was your credit limit, and then what was your balance. So it's going to look at those 4 things, and that all revolves around credit utilization. And as you guys all know, 5 to 9% is where you need to keep your utilization to get the most benefit from your credit card, from a scoring perspective. So what are 3 ways that people can actually beat trended credit data? Well, one thing I would tell you to do is keep your revolving balances down low, 5 to 9%, but it doesn't cost you anything to increase your credit limit. So I would call my creditors, and as long as they don't pull a new credit report, increase the limit as high as they will let you go. Because utilization only doesn't care about how high your credit limit is, it just cares about how much you use. So as long as you have the self-discipline to keep your balances low, you'll be fine. Increase your credit limit, that's rule number 1. Number 2, installment loans will have trended credit data. So how can you improve your score based on installment loans when you're supposed to have a fixed amount every month? Well, what you could do is pay $1 more on your installment loan payment, and that can go to principal. So on all of your installment loans, when you have the automatic pay set up, you're going to have $1 extra. So make the payment plus $1 every month. That way, when trended credit data is considered, you're going to actually be better off from the installment side. Revolving remains at, make sure you keep 5 to 9%, but installment will have trended credit data, and that's one way to improve your trended credit profile. Number 3, and the most important, is going to be pay before the reporting date. I've talked about this before. It becomes critical that you find out when your reporting date is and make sure you get your balance down to 5 to 9% if you can, but as low as possible before the reporting date. The reporting date has never been more important than it is now with trended credit data. So make sure you really need to take control of your finances and find out when the creditor reports the information to the repository. You want to get your balance down as low as possible on the day before they report that information. And I had a call come in on this just this morning. When do they report? There's 2 ways you can figure it out. 1, call them, okay? Call them and say, when do you guys report your information? Number 2, you want to check what they tell you. So go online every day and look at your current charges on your credit card. And when the current charges are no longer there, the day before that is the reporting date. So the day before, so when you're checking your current statement and it has charge, and you come in the next day and those are all gone and on the previous statement, then that was the reporting date, that prior date. Okay, so you're going to know on the next month, right around that date is when you're going to keep your balance as low as possible. Make your payments before then, not on the due date, on the reporting date. More important than ever with trended credit data that you keep your balances low.